Okay, hello everyone. Good afternoon. Welcome. Gonna let people join here for just a second. Still got some folks popping in here. It's great to see you all today. Welcome to our webinar. This webinar specifically is titled Geopolitical Events and AI When Predicting the Future is Harder Than Ever. And I think it's going to be very interesting today. We have obviously a lot to talk about. But we want to make sure that we cover things that are on your mind. That's how we can make this just as valuable as possible. So I want to walk through a couple of quick housekeeping items to help facilitate that. The first thing I want to mention is that this will be so much better if you ask questions. This is meant to be interactive so that you can pop questions into the chat. If you look at about the 50-yard line on your screen, you'll see the chat box. You can go in there and ask your questions, and we'll do our very best to get to all of them. If we can't, we'll be following up with you afterwards to help make sure that they're answered. Um, Today's purpose is really to walk through current events, walk through what's going on in the market, and have a unique perspective from a special guest. Before I introduce our guest, I did want to do one quick shameless plug. Warburton Capital is excited to have launched its very first podcast called Wealth, Purpose, Peace. If you go onto YouTube, Spotify, or Apple Podcasts and search for either Warburton Capital or Wealth, Purpose, Peace, you'll be able to find it. Our first episode launched last week. Our next episode's coming soon. Our very first episode covers the topic of how much money do I need to retire? So, very relevant. Our goal with the podcast is really to make it different than every other finance podcast out there and to get a little more philosophical and dive into the questions behind the questions. So, my colleague Brian Grant and I do that, I think, in a fun way on the podcast. So, I hope you'll, following this, look up that first episode and let us know what you think. Let us know what you'd like for us to cover in the future. Okay. Well, without any further ado, I'd like to introduce our special guest, Dr. Apollo Lupescu. He is a PhD in economics. He works at Dimensional Fund Advisors, which is a premier global investment manager with about $1 trillion in assets under management. He's known for his ability to translate complex investment concepts into clear, accessible language. I think you'll see that today. Apollo's earned the nickname of Secretary of Explaining Stuff. He's globally recognized as a speaker who's delivered hundreds of lectures and town hall events, and now several to Warburton Capital and our clients. We're very happy to have him here today. He's able to cover a variety of topics, really any topic you can think of. So throw us your hardest questions. Let's see what happens. Apollo brings 2 decades of experience working with Dimensional, where he applies the analytical rigor developed during his earlier career teaching at the University of California. He holds a PhD in economics and finance from UC Santa Barbara, a BA of economics from Michigan State, and at Michigan State, he also competed and coached water polo. So these days, when he's not helping clients navigate the crazy markets like we're having right now, you might find him navigating actual waves in the ocean. I think there's some synergy there.
Anything to do with water.
Well, Apollo, thanks so much for joining us and taking the time. I'm going to be keeping an eye on questions as they pop in the chat in the middle here. But let's start with the most obvious thing. There's a lot going on this year. It's only April, and it feels like it's been a whole year so far. So we've had Supreme Court ruling with tariffs. We've had a lot of news coming out of Washington, D.C., and now news every day coming out of the Middle East. We've seen the market react to that. Can you walk us through from a high level your thoughts on what's going on in the world right now?
Yeah, no, it has been, as you said, a really crazy year. And first of all, Jonathan, thank you so much for the invitation to be part of this. And again, I still I'm so fondly remembering the event that we did in town a while ago. And with all this nuttiness that's been going on, there has been a lot of anxiety, I think, among investors and everywhere I meet with folks, and whether it's in the US and frankly, I just came back from Australia, pretty much everywhere. Folks are anxious about not only what's going on right now, but what this could lead into. And you have concerns about what if this war escalates and it gets bigger. You have concerns about, what if this leads to an economic downturn or, maybe inflation. And a lot of folks are already seeing pretty much across the globe, gas prices going up, and so forth. So the first thing that I have to say is that when you look at the financial picture as an investor, it's a different story. It's actually quite surprisingly different than the perceptions that people have. If you look at the global stock market, which includes the US, it includes Australia, Japan, all the countries that you might be invested in, for the first 3 months of the year through the end of last week or so, what's remarkable is that the global stock market is pretty much flat. It's pretty much flat. It hasn't really dropped that much. So in that respect, when you look at the US market, the US is down a little bit. I think for the quarter, it's roughly about 3% or so down, which is nothing dramatic, 3-4%, pretty much identical to what happened last year. Last year was on 4.3% through the first 3 months of the year. This year is identical, negative 4.3%. So we're not seeing something that is very dramatic in the U.S. market. And what's also interesting is before the war started, the market was actually ahead. And then the market dropped about 5% or so, 5-6% during the month of March to make it slightly negative. But again, nothing really horrific. And when you look at international, developed, and emerging markets, also we're seeing some positive numbers there. So by balance, like if you look at your account, you're not going to see a huge drop, and you're not going to see something that mimics that anxiety that people have in other parts of their life. When you come out to the other part of your portfolio, because most of you are not only invested in stocks, which are about ownership in companies, but there's a form of lending where governments and corporations borrow money. And if you're an investor that lends them money, that's through something called a bond. What you're seeing is that bonds as well are pretty flat for the year. So neither in stocks nor in bonds do we see a dramatic drop, but rather it's a pretty flat year. And all things considered, to your point, that's actually really good news that through the first 3 months of the year, despite all this nuttiness, you're not going to see big losses on a balanced portfolio, let's say a 60-40, but rather pretty much flat for the year, which all things considered, it's good news.
Well, that is good news, Apollo. And I want to hone in on one thing that you mentioned specifically, which was inflation. Of course, that's a topic that we covered in person at our event in Tulsa not that long
Right,
ago.
right.
Um, it felt like we already fought the inflation wars a couple years ago, and now there's talk of it again with rising oil prices. Can you address thoughts on inflation maybe being caused by the war in the Middle East?
Yeah, and I think that there are two really important elements. The first one is that back when we talked about this is like maybe 2 or 3 years ago. The big driver was the fact that we had some stimulus checks, and at the same time we had the economy that didn't really function, not only in the U.S. but really much globally. So at that point, you had quite a few dollars chasing not as many goods, just because the economy, the global production was constrained by the pandemic. And obviously, if people still have money and there's not as much, well, the only way to achieve the balance is if you bid up the price. And that's exactly what happened. We had inflation that was caused by the supply chains and generally by the pandemic as being one of the main drivers in those days. And at the time, the Federal Reserve, once the inflation spiked, they really sprung into action. And literally within about a year or so, we went from 7, 8, 9% almost back down to about 3%. So inflation did come down quite substantially, and by the end of last year, we're very close to the long-term average. There was not really as much inflation by the end of 2024, and 2025 was pretty quaint as well. Now, when this war started, inflation basically is not about any one single product. It's about the economy as a whole, a basket of goods. And what we're seeing so far is that inflation really hasn't moved up so much. partly because the war did not start till the beginning of March almost. So we don't have quite the reading. I think this week there'll be some inflation numbers. But the reality is that when the oil price went up, that's a situation where some of you might actually be excited about this because if you're in Oklahoma and you see prices of oil go up, well, that's good business. On the other hand, as an economy as a whole, what happens is so much of the economy is still reliant on oil and gasoline. And once these prices go up, there's a point where the companies that use this, whether it's for food transportation, whether it's for whatever the case might be, at some point, if they have to pay more for transport because oil is getting more expensive, well, they're going to have to pass the price up to consumers. So the expectation is economically is at some point, if the oil prices stay high, then this will actually lead to a higher inflation. You might already see that higher inflation in the next month or so, because if you look at gasoline prices, I mean, we were talking about before, like it's 350 on average in Oklahoma and Tulsa. By the way, it is about $7 in Los Angeles. So prices have been going up. And if they continue to stay elevated, at some point that's going to be reflected both in the inflation that includes gas as one of the components, but also in the cost of many other products that we might buy. So it's quite possible. It's a little too early to tell, and particularly by how much. And so much of it really depends on how fast will this conflict resolve itself, or maybe not resolve itself, because it's a very complicated, very complicated situation going on right now. You know, I don't know that anybody was that prepared for it because it came out of nowhere in a way, not a lot of time for businesses to prepare and for consumers for that matter to get a mindset of, hey, we're in this together. It's a war, so it's a very complicated situation. But I would expect inflation to bump up.
Yeah, very, very good thoughts and helpful to get your perspective on it because, as we know, when we invest globally and we invest in a really diversified manner, the great news is that that means there's often silver linings in a variety of circumstances, but then also everything kind of impacts the portfolio and there's a ripple effect throughout the portfolio.
Absolutely. And to your point, I mean, if you look at Exxon, Chevron, through the end of March, they're up over 30% in value. The market's pretty flat. Exxon, Chevron, oil companies up about 30 plus percent in value for the year. That's really good. But the other big one that I think is so important, you touched on this and I didn't as much, which is so relevant to you when you think about these prices going up, well, who exactly is collecting those additional dollars? And quite often, these are companies that are part of the stock market. So if they're collecting more dollars, you know, in fact, their value is going to increase as revenues goes up for those firms. So a lot of times, one of the conceptual best place to kind of make sure that you stay ahead of inflation is actually be invested in the stock market. And we've seen this historically that the stock market not only that has kept up with inflation, but in fact deliver returns above inflation. But think about this: if I'm going to pay more for toothpaste, or if I go to Costco and I pay more, or Walmart, whatever, who's collecting the additional dollars? Well, those companies might be part of the stock market, so in a way, they are increasing revenues when inflation goes up.
It's a really good point. And I'd like to build on that for a second because we've talked about inflation potentially being a result of these actions in the Middle East and an increase in oil prices. And that makes logical sense, right? So
Right.
then investors take a step back and think, okay, what am I to do about this? Is my portfolio positioned in a way that I can handle inflation or take advantage of it? And the way we look at it at Warburton Capital, as you know, Apollo, is okay, we've got our spending needs set aside in bonds. So if we need money to spend out of, that's here in bonds. Maybe we have an inflation protecting sliver in there, maybe not, depending on the situation. But the greatest protection against inflation, in my opinion, is the long-term value of growth in the stock market. And that's not what we hear. What we hear is gold. So I'd like your thoughts on both comments. One, the stock market being a good protector against inflation, which you've touched on. But then secondly, is gold actually a good thing to invest in to fight against inflation?
Yeah. So on the first point, I'm 100%. And by the way, I mean, I think that what Jonathan said is so important. Every one of you has a different plan that was built very custom to your needs. And that plan takes account that inflation might come along. And there are some assets, including some assets that are called inflation protected securities. And those in fact, go up in value pretty much in lockstep with inflation. So there are tools that advisors have, but those are very custom tools that can be brought in depending on your circumstance. So I think that revisiting your plan is probably the best thing if you are a little bit concerned about it, because I have no doubt that the plan is taking account of this. Now, what about gold? And I think it's interesting, and Jonathan, to kind of give it justice, it's probably good to go back to the origins of how we got so attached to gold and inflation. Because gold has been had some level as a precious metal has had some level of association with value for the entire human history. And it all has to do with scarcity. There's not as much gold. But gold wasn't the only precious metal. There are tons of other precious metals. And if you go back to the election in the early 1800s or so, President McKinley Canada at the time was suggesting that gold ought to be the precious metal that backs the dollar, because before that there was no precious metal backing that, and the other candidate was looking at silver. And because McKinley won, the U.S. Had what's called the gold standard. In other words, in order for the U.S. government to print a dollar bill, it needed to have a certain amount of gold in the bank. Now, the good news is not only that it gave people confidence that the dollars have value since they're backed by gold, but it also gave gold a credibility because look, it's tied into the U.S. currency, which certainly going back those days, it was starting to become the most preeminent currency in the world. So that was a really powerful thing. Now, what's happened over time is as the economy got bigger, there are more people in society. In the 1960s and early 70s, economists were pointing out that we're not digging up enough gold. We just don't have enough gold to print all the dollar bills that we need for the economy to function. And what happened is in August of 1971, President Nixon goes on TV and he tells the world that as of today, gold is no longer connected to the dollar. And as of that day, the US dollar became something called a fiat currency, which simply means that it's not backed up by any precious metal, but rather by our collective belief that the dollar has value and the government will not overstep its printing machine abilities. So the idea is that hey, even though the government can run the printing machine day and night with no backstop, we do think they'll be responsible. And in fact, what's interesting is that it is not the government that runs that printing machine. The money is released in society in the U.S. by the Federal Reserves. And for the longest time, the Federal Reserve had no real say in that because it was tied to gold, and only what gold we had can be print dollars. But now that you are in this regime since 1971, the Federal Reserve can release, whatever number of dollars they decide in society. And people are very nervous. And in the early days, in the early 70s, what he had was a situation where the Fed was not independent. And a lot of decisions that they were making were based on political interest, including Nixon's. And over the years, you had a few of these. Inflation started to go up. We had the 73, 74 oil shock. We had a lot of things going on. And because of that, what's interesting is that if you look at the value of gold, once it was allowed to be freely traded after that conversion, after the switch from the gold standard to just fiat currency, what you saw in the late 70s, mid to late 70s, it was a huge spike. It was a 5x increase in the value of gold. I mean, not only that it kind of gave people a feeling that, hey, gold is a good way to protect against inflation because the economy was so bad and inflation, but at the same time, it also makes money. Look, it's a great way to make money and protect because people were concerned about the health of the US financial system and the dollar. And in the late 70s, a new Fed chairman came along. His name was Paul Volcker, and he cleaned things up. He said, we're going to be fiercely independent. We're not going to take orders from the executive branch, and we're going to stabilize the economy and the dollar. And that's exactly what he did. That's exactly what he did. And when people realized that, wait a second, maybe the dollar is not going anywhere, inflation is stabilized. What's remarkable is that if you look at the history of the price of gold, what you see is that quite remarkably, Jonathan, there was a 20 to 25-year period when you would have been on the water in gold. If you had bought based on that anxiety of the mid 70s, oh, everything's falling apart, we're going to be doomed and gloom, what you had is 25 years when not only that you did not make money, but you didn't cover inflation. Inflation went up several times and you were on the water with gold. A very, very long time to be underwater. 20 to 25 years of not making money and waiting to recoup the same price that was in the early 80s. And then we had the financial crisis, the great financial crisis. And some people again like, oh, the financial system's doomed. We're going to have all these issues. And then it turns out that it didn't go away. The dollar was still around. And then we had another 10 or 15 years when the gold did nothing. Gold did nothing. You're still kind of, waiting for that price to recover. And then over the past few years, we saw a similar situation where you had Ukraine and central banks said, well, maybe I don't trust the dollar. I'm going to buy some gold. And you had maybe investors kind of hearing about the dollar and inflation and perhaps the stability of the government, whatever reasons might have been. We saw once again a spike in the price of gold. So to me, history, Jonathan, doesn't really repeat, but it certainly rhymes. And it does seem to me there are times when, whether it's governments or individuals for a variety of reasons, that people jump and buy gold, and then you're left with something holding that doesn't really go up in value for long periods of time. And if you look over the entire history, you would have made money. A dollar invested from the mid 70s to the end of last year, it would have increased in value 26 fold. So 26 times increase in your money in gold, which is it's good. So you would have stayed ahead of inflation despite even these long periods of doing nothing. The trouble is that if you say yes to gold, you say no to something else. And what that something else might be is the stock market. And we talked about the stock market as being a place where, companies can increase prices and it's reflected in their value increasing as well. And if you look at the stock market over the same exact time period, it certainly had a bit of a larger growth. The question is how much larger, how much more could you have made in the US stock market relative to the gold market? And the answer is significantly more. Instead of 26-fold, it was a 293 times increase in the value of a dollar. So significant difference. So to me, this idea that gold somehow is going to be a hedge against inflation, I don't really buy into it. It's not in the data. Gold is very, very fluctuating a lot. Prices are pretty stable. Even though they grow up a little bit, they don't move as much as gold. But by and large, there's an opportunity cost that instead of you being invested, let's say in the stock market, you're putting money in gold, and over the long run, there's a huge difference in that opportunity cost. Now, with that being said, all of you, by virtue of being invested globally in stocks, you do have exposure to gold. Because you look at in Australia, there's a Newmont mining, and it was up like over 100% last year. You had Canadian stocks that last year did tremendously well, and there are a lot of gold mines. So you already have some gold mine exposure. I just don't believe that you need anything extra on top of that, unless you want to buy your significant other some jewelry. But outside of that, I don't believe that gold has that ability to function as a credible hedge against inflation. It fluctuates way too much. You had a 25-year period when it didn't cover anything. And even this year, like as you saw concerns about inflation in March, what did gold do? Dropped in value. It didn't even increase. So it is a funky investment because it doesn't have an economic activity. It does have that history and the perception that people have. But when you look at data, you have much better options. Over the long run, you're much better protecting the stock market, in my opinion, because there's an economic value that drives it. And over the short run, you could do something like if you're really, really concerned about inflation, some inflation protected securities. So I don't look at gold as saying it's the it solves anything, except makes your spouse happy. But even if there's a financial crisis, Jonathan, that really the dollar collapses and all that, and all we have is gold, what are you going to do? Like take a bar of gold and start shaving a little bit to buy milk? It's just not necessarily the I'm not sure in what context. I think it's more of a legacy idea rather
Right.
than something that is today like really reflective of the system that we live in.
Yeah, I think that's insightful, Apollo. I often will share with clients similarly, okay, how if we buy all this gold and if we buy it physically, okay, the apocalypse happens, now what do we do with it? I think whiskey, ammunition, cigarettes, those are going to be better currency in the post-apocalyptic landscape.
Yeah, that for sure. Particularly with
So we do have a question that's come in on this topic. So we're talking about using the stock market as an inflation hedge. This person asks, should we increase our exposure specifically in defense stocks? So I guess defense companies and military spending companies as an inflation hedge.
yeah. To me, like a lot of these defense companies are not necessarily driven as their value is not as much driven by inflation as it is by conflicts. And that's the interesting thing is because when the conflict like this happened, and like just give an example, the bombing of Tehran happened on a Saturday. On Monday, Lockheed Martin, which is a defense contractor. I think the stock jumped 3 or 4% or so that day, the day after. And that was a reflection that we expect that the government will buy more. So when you're looking at protection against inflation, I'm not sure that those are the stocks that would necessarily kind of give you the best hedge against inflation because they're, in my opinion, they're much more driven by global events, such as the war starts. Well, we're going to need more radars, we're going to need more bombs, and so forth. And that's probably a bigger driver rather than the gas price and maybe the other issues associated with it. Number one. Number two, the trouble is that if you're chasing some inflation hedge right now, except for these bonds that we talked about, what's interesting is that when investors assess that this is a good hedge against inflation, let's say they could be defense contractors. The thing that the market does is very, very quickly adjusting prices to reflect that benefit to investors. So if there is a benefit to investors in that respect, you're going to see the price of that particular company go up in value. So by the time you decide to get it, it's quite possible that you're paying a relatively high price. And at that point, it might not necessarily be a good deal. So rather than focus on individual parts, whether it's energy or whether it's with a defense contract or whatever, I would just say comprehensively by the global productive capacity, because we do expect that the global productive capacity will keep up with inflation. And what it means is that you ought to own roughly about 10 to 12,000 different companies in about 40 different markets. And that's, I think, what you have access through your portfolio. So I wouldn't focus on any one sector saying I need to buy more of that, but rather I want to ensure that I buy the global productive capacity.
Excellent. Thank you, Paula. We had another question come in as well, which is great. Please, as a reminder,
Yeah,
feel
I'm
free
so
to,
happy to see that. Yeah.
yeah, feel free to pop your questions in and we'll do our best to get to all of them. So this person asks about once oil reaches that $100 a barrel line, and they're asking what history says, back to history, which as a history major, I love all this. I
Yeah.
love that we're talking McKinley, we're talking William Jennings Bryan, the cross of gold. It's great. Um, so once we hit $100 a barrel, what does history say about that translating into the economy? Inflation is an example, but are there other ripple impacts of that on the economy?
Yeah, and it's a really interesting question. What makes it hard to look at that particular number 100 is basically that number 100 is reflective of prices in 2026. So if you go back in history, maybe 100 would have meant 40 or 50 or 60 just because prices were different back in those days. So to me, I'm not sure there is something specifically attached to that number. But generally speaking, what you're seeing is that pricing of oil right now, and as you know, being there, it's a very complicated business because you might have the price of West Texas Intermediate, WTI, which might be different than Brent, which is coming out of the northern countries. You might have a spot price that's different than the future price in June. So all of these dynamics make very hard to interpret a single number for oil, and in general, putting a number for oil is really tricky. But what I will have to tell you is that to me, the biggest thing, it's not necessarily the oil price, but it's the gasoline, because that's what ultimately a lot of us are going to feel. And to me, it's not necessarily the price of oil. If it goes up, and even if the gasoline price goes up, and we're talking about earlier, the horrible thing is that people will be impacted. And maybe not folks on these calls, maybe, but there are folks who live on the margin. And if they pay $50 a month more for gas, that's going to be painful. And they might have to make trade-offs of what am I not getting this month. The issue is that the price of oil and associated price of gasoline, it has to somehow increase, in my opinion, if we're not getting a fifth of the oil global, because that's how much is supposedly passing through that Strait of Hormuz. And everybody's now is a geography expert, but it's a lot of oil going through there. So if that's not available on the market, well, that's an issue. And because oil, it is liquid. And the great thing about oil being liquid is that, hey, if I can sell it from the US to Asia and they're going to pay me $100, well, I'm going to sell it to Asia rather than a local store that might buy it for 80. So, oil can be moved fairly easily around the world, not as much with liquefied gas and natural gas, but that's a different story. The reason I think it's interesting is that when you look at the price of oil and gas going up, it doesn't bother me as much as putting a cap on it. The biggest issue that I see is that if people are trying to protect and say we shouldn't go above a certain level, I actually think that could lead to bigger problems. And to illustrate this, both of these points, back in the 1970s, there was an oil embargo where countries that were part of the Organization of Petroleum Exporting Countries, OPEC, they did not like the U.S. policies in the Middle East. And particularly, like, they're like, hey, you guys are too attached to Israel, and you're not really being balanced there. So what OPEC decided in 1973 is to put an oil embargo, and said, we're not shipping any more oil to the US. It's our choice. We're not going to sell to the US. And at the time, the US did not have pretty much any domestic production. So what it meant is that, hey, gasoline is going to, be hard to find. And the problem is that at the time, the gas prices were about 40 cents a gallon, 40 cents a gallon. That's why it's kind of hard to compare across time. And what the government said is like, well, to protect citizens, we're going to go from 40 cents a gallon to 50 cents a gallon. So we're going to increase, but we're going to put a cap. We're going to put a cap at 50 cents a gallon. And the trouble with the cap is that if you're not allowing supply and demand to work together, you're going to have imbalances. And the way that they express themselves in 73, 74 is through empty gas stations. You'd go, and if you're in the sucker, this is 73, 74, you'd be like, I'm willing to pay 70, 8, whatever it is, but he couldn't. And because gasoline was not allowed to move up in price, it led to shortages. So I think that's really interesting because, like to me, there's no magic to that $100. But to me, if it goes up, I think the positive of that is that if you allow prices to go and align supply and demand, at least we will have gas. If you don't allow the prices and you say, well, I'm constraining the price somehow, then the issue is shortages. But that's the good news is that, well, I'm not hearing anybody kind of saying let's cap the price of oil or gas. And it was a very convoluted answer to your question, but I do want to reflect that the number 100 doesn't imply much at all for the economy or inflation. It's just an arbitrary number, and across time, you can't even compare it because the inflation over time. But then the fact that it goes up, in a fact, is a fact of life that some people might be hurt. But the good news is that if you allow prices to adjust, at least you will have gas at the stations.
This reminds me of my very first econ class. where you had supply, demand, and then the impact of price floors and price ceilings.
Yeah,
And
exactly right.
there are often unintended consequences from those things.
Trying to do something good, but it ends up being the opposite.
Yeah. Okay. I like where we're going with this. I want to take it a little different direction. We've talked about gold and obviously the conflict in the Middle East. Let's stay in this lane, but transition and talk about the US dollar a little bit. So I
Okay.
know there's a lot of concern about the value of the US dollar changing and the de-dollarization of
Yeah.
trade and the global standing of the US dollar. We hear a lot about that these days, and I'd be very curious on your thoughts, as I think it does relate to inflation and oil and all these things kind of relate to one another.
For sure. So let's talk about this. And to begin with, I think what's interesting, Jonathan, is that there's clearly been an effort over the past year and change with the new administration to reduce trade with the world. And that's been certainly obvious between tariffs and policies and just like the way that we're approaching the. Now, what's fascinating about that is that the US is about 4% or 6% of the global population, and we amount to about 25% of the global economy. That's so the US is roughly a quarter of the global economic activity in the world. Now, the other way to think about this is that 75% of the world economy is outside of the US. And over the course of the year, what's been made abundantly clear is that, hey, if you're going to build a moat around your country and build up some walls and don't want to trade, great, knock yourself out, trade among yourselves. But the rest of the world will continue to trade. And we've seen exactly that, like things that used to go to the US are now going to Europe. So the rest of the world is still trading. Now, to what degree is the dollar impacted by this? And the answer is, well, let's look at some data to see that. And let's start with the value of the dollar because you hear so much about the value of the dollar tanking. And last I checked, and it's not vastly different today. In fact, the dollar is a little bit stronger today than what I'll show you. Is that if you go to the European Central Bank and you look at the exchange rate between the US dollar and the euro, well, this is what it looks like. And the value itself might not mean any much right now. What I wanted to start with, Jonathan, is just a visual. Look at the visual and see if somehow where we are today is it's some absurd, unusual, unprecedented level between the U.S. and the euro, and the U.S. dollar and the euro. And what's remarkable is that in fact today we are pretty much at exactly the long-term average. So if you're going to do a trend line and say this is the long-term average, that's exactly where we are. And there are periods when the US dollar was significantly stronger, which is not good for investors and companies exporting. But there are also times when the US dollar was significantly weaker, significantly weaker. And if you look at this right now, you see like, hey, it went up for quite a while between 21 and maybe 23, and then it dipped quite significantly and went up and it goes down. But where we are today, it does not appear to be some abnormal, out of the ordinary. In fact, it's pretty much the long-term average. So I think it's a little bit overblown that the U.S. is losing value and so forth. It does not appear when you look at the data. And even more interesting, when you look at the Japanese yen. When you look at the Japanese yen, and I was in Tokyo not too long ago, and I got probably 120 yen for $1. Today, you're getting close to 160 for a dollar. So the US dollar has actually strengthened significantly relative to the Japanese yen. And when you look at our, one of our largest trading partners, even after all this, China, it's pretty much flat. It hasn't really changed pretty much at all. So when I look at the data, I don't really see evidence that somehow the US dollar is losing value left and right and it's just like in big trouble. Not at all. It just appears to me that it's pretty much in line with the long-term trends, and it's right now it's close to average. So I think it's a lot more noise than rather than rigorous data. Now, how else can you see if the dollar is still losing value? And one way is to see how many of the foreign exchange reserves, meaning other countries when they hold currencies in their central bank, how much is in dollars. And not long ago, at the end of September, that was about 57% of all the official foreign exchange reserves were in US dollars. And the next one up was euro, which is like it was almost a third. So there's no doubt in my mind that the US is still by far the most dominant currency in the foreign exchange reserves. And if you look down, the Japanese yen, the Canadian dollar, I mean the Chinese renminbi is pretty much less than the Canadian dollar, and at par with the Australian. So not that much. But how has this changed over the past decade? So if you go back 10 years, what you see is that the US has lost a bit from 57 to 64. But really, who gained? A little bit of euros, a little bit of the Japanese yen, a little bit of the Canadian dollar, but nothing outrageous, nothing to say, wow, the world is different today. No, not at all. Like Chinese went from nothing to next to nothing. So it's not like a huge change. Now, that's interesting because when you're talking about foreign exchange reserves, these central banks, they're not stashing dollar bills in the vault. They'd be silly because, hey, I want to make some money. I want to, make sure that it's safe, but I want to grow the dollar bills. So what they do is they buy bonds. They buy U.S. government bonds. And that's been, the way that these banks actually hold dollars because U.S. government bonds are very liquid, they're safe, so it's not a problem. Now, lately, as we've tried to weaponize a little bit the dollar in some ways, countries are becoming a little bit more like, hey, listen, there is a counterparty risk when it comes to bonds. But one thing that not really as much of a counterparty risk, and perhaps even a more lucrative way, is perhaps look at other investments in the US, such as the stock market. So the question is it possible that maybe some of the money that used to go in US government bonds perhaps now are going into the US stock market? So if you look in that respect at the foreign direct investment in US stocks, in 2015, it was about 5.2 trillion. And by the end of 2025, it was 18.12. So over the course of the past decade, foreigners have invested over, about $13 trillion in the US stock market. So in other words, investors are still very confident in the US, but perhaps what they're doing is switching a bit from bonds to stocks. But it's a great conviction in the ability of the U.S. government and the U.S. market, in fact, to continue to produce. So again, we don't see a lot of evidence that this is fundamentally changing. So is there evidence that the dollar is falling and it's no longer the dominant currency of the world? And the answer is it's possible that in one day, but right now, unequivocally, the answer is no. There's no reason to believe that anywhere in the near term, the dollar will be replaced. And the first reason, which is the most obvious one, is that if you don't believe that the dollar is the most dominant currency, what is the credible alternative that individuals, businesses, and governments would prefer and trust more? What is the credible alternative? And the answer is you tell me. I mean, I can't think of any. And in fact, there is a metric that we can look at to see, the volume, the daily volume that involves U.S. dollars when people exchange money. And what's remarkable is that if you look at the foreign exchange based on average daily volume, 92%, a full 92% of all the transactions in foreign exchange involve U.S. dollars. Because if you are a merchant you're selling coffee in Colombia to a street vendor in Italy, well, both prefer dollars. Both prefer dollars. The European euro is 5%. The Japanese yen is 1%. Everybody else is about 2%. So when you hear that the Chinese and the Russians are trying in renminbi, yeah, it's possible. That's the 2%. But 92% of the world still every day, not 92% of the world, but 92% of all volume of foreign exchange involves dollars. And that to me is a very clear sign that at the moment there is no credible alternative to the dollar. And if I were to give all of you folks three suitcases full of cash, the same amount of cash, one is in dollars, one is in euros, and one is in Chinese renminbi, you tell me which one would you pick? I mean, I've asked this question around the world. Like, there's no like they're laughing. It's like, why would anybody pick anything else but dollars? It is still the most trusted currency, despite all the troubles that you might hear about.
Very helpful. And it is interesting to see what real actual data shows as opposed to headlines and things that we hear um, around town, right? And hear
Oh,
from friends. And
absolutely.
it's very interesting.
I
I
mean, yeah.
we did have one question pop in here. If we go back to the oil discussion just for a moment,
Yep.
um, the person asking the question referenced the fact that in Iran there have been there's been a lot of damage to places that facilitate helium, and so could there potentially be any sort of gain to be had by investing specifically in, counterparties to companies that are impacted by a helium shortage, or I may not be asking the question very well, but
Yeah.
I'm doing my
Yeah, I
best
get
here.
it. Yeah.
So helium got hit. Can we make money off of this somehow?
Yeah, and the truth is that helium is a gas that once again requires some pretty intricate processing to be shipped around. And the good news, the byproduct of digging oil. I'm not an oil expert. You probably folks, some of you on the line, are probably a lot more knowledgeable. But just as a general knowledge, I do know that helium is a byproduct of oil and gas. And it turns out that in the U.S. we have quite a bit, so there is no real shortage here. But some of the facilities that got hit in Qatar, they did have helium, and helium has a lot of applications. Some of them might actually have to do with AI centers and so forth. So it's a very complicated. But to answer the question specifically, when this conflict started, nobody had a precise idea on the impact of the conflict on companies. But Monday when the market opened, we talked about maybe Lockheed Martin maybe going up in value. At the same time, you had American Airlines or some other airline kind of with a lot of flights in the Middle East going down in value, which you would expect. But the market as a whole was unchanged. But and the signal was that based on everything we knew on that day, we didn't expect that many companies will be impacted in the US and their profits and earnings, which pretty much drive the value in the market by this conflict. What happened is, as the Iran strategy became clear, which was not known on Monday, nobody knew on Monday what Iran will do. But when they became clear that they're kind of saying, okay, well, if you're going to impact us, we're going to impact you. And it became clear they're going to shut down the Strait of Hormuz, which wasn't necessarily something that was obvious at all. Then at that point, a lot of the prices of different companies started to adjust. So if you had companies that were either negatively impacted by the helium expected shortage, particularly as they hit the facility in Qatar, all of a sudden those stocks dropped like almost immediately once the expectations settled in. The same way that companies that might sell helium and might go up in value, those popped up as well. So to try to right now try to find areas of the market or individual stocks that might benefit or get hurt by helium is way too late. Is way too late because that has already been priced in. And the reason that these prices might move up and down going forward is not because of something we know or expect, but something that is currently unknown or unexpected. So, because of that, I would caution anybody to make a play right now because it is ancient news in the market. What happened to helium? The prices have well adjusted by now to reflect the good or the bad news on any one individual company.
So Apollo, when I was a kid, there was this TV show called Early Edition. Did you ever see that?
No.
You're probably getting your PhD in economics, but um, I was watching Early Edition, and it was this really funny concept where this cat would bring tomorrow's newspaper to the hero's house every morning, and then he would go out and try to save lives and try to, stop the car crash and all of that.
That's funny.
And you just about have to have a magical cat bring you tomorrow's news
That's
in order to be able to make money off something like
exactly right.
that.
That's exactly right. Because otherwise, yeah. And even then, you have to be careful because, yeah, it's even if you knew the news in some ways, even if you knew the pandemic is coming, would you have sold the stocks or bought stocks at that point.
right?
And if you thought like, oh, I'm going to sell stocks because the cat told me there's a pandemic, it wasn't the right call for the 28 20. I mean, you would have made money that year in the market. So, but that's a funny story. That's a great way kind of
Yeah.
watch.
Yeah, it was a good show. Okay. Well, I do want to make sure we hit one more big topic that we're getting a lot of questions about, which is the potential of an AI bubble.
Yep.
So, um, AI stocks and companies that are affiliated with AI or involved in AI have just grown tremendously over the past few years. And there's a lot of concern about this being something like another dot-com bubble or
Yeah.
something like that. And now you've got OpenAI potentially IPOing this year and just a lot of headlines about it. I'd be curious what your thoughts are on that.
Yeah. So AI, it is an amazing technology. There's no doubt that it's revolutionary. I think the last time that I saw this is in the internet age when the internet got started, that you kind of see the potential of this industry. And what's really interesting about the internet and AI is quite often the bigger beneficiaries are not necessarily the creators, but rather the users. So it is fascinating to see that companies that are benefiting from AI right now, they could be pharmaceuticals that can launch better medicines, or it could be logistics companies, or it could be retail stores. So AI will have an impact, and the question is, should you hyper focus or should you be scared of these AI companies? And for sure, there'll be an impact on jobs, but that's beyond the scope of today. But let's look at what it meant for companies. And particularly, as you said, in terms of their value, particularly if they're associated with AI. So let's take a company that has staked its future on AI, and the owner, the founder, made it very clear, and that is Tesla. Love it or hate it, Tesla is a very interesting case because they're going to stop making Model S, which is the original car, and Model X, which is the little SUV, which are the two bigger money makers. That's what they make. That's where the margins are greater, and they said we're going to stop making those. And let's look at that stock price because it is tied so much into AI today because they said it's all about AI. So if you look at Tesla at the beginning of this year, the price for a share of Tesla was roughly about $450 a share. So what do you get for 450? You can go have really nice dinner, or you can buy a share of Tesla. Well, what you get for the share of Tesla is to partake into the ownership of that company. Pretty much like Elon Musk, not as much as Elon Musk, but you get to partake in the company. And because you're now a business owner in Tesla, you get to actually get part of the profits that the company makes, because that's what you do in any business ownership. If you have a piece of a business, you partake some of the earnings of that company. So the earnings associated with that one share of ownership at the time when the Tesla was selling for 450 at the beginning of the year were roughly about $1.50. So let's reframe this, Jonathan. So you just spent $450 at the current rate of earnings, Tesla comes and puts $1.50 into your piggy bank every year. So at the current rate of earnings, if you paid 450 and you get $1.50 per year, how many years will it take for you to make that initial investment back? Well, it's not that complicated. It's going to be roughly about 300 years before you make your investment back and you become ahead of the game. And it's also fascinating because you take another company like Toyota, a global company that is still making gasoline hybrid engines. At the time when Tesla was selling for 450, their price for Toyota was less than half. It was about $215 a share. And the earnings per share were roughly around $20, which meant it was about a 10 years payback. So here's the thing that happened with AI, and this is a good illustration, is that if you ask why would anybody buy Tesla? It's so expensive relative to a Toyota. Well, here's the thing. Nobody expects Toyota's sales to just blow out of the water. But the expectation is that, wait, if you just give Tesla some time, they're going to open up the money spigot. They're going to make money left and right, and it's just going to blow it out of the water. It's just going to be an amazing opportunity. You're going to make so much money in that company. And it's possible. I mean, that's why people say don't bet on Elon Musk. If you had the guy for dinner 25 years ago and he told you, by the way, I'm thinking about launching a rocket company. And up on that point, only a handful of countries have even put rockets in space. And no, I'm going to do it. You would have said, okay, little buddy, go try it, see how it goes. Let me know. Nobody would have said that, yeah, that's going to be a successful venture. And yet he did it. The same with the car company. So what the investors are saying, I'm willing to pay 450 now because I expect these earnings are going to blow out of the water. Just you wait till they make so much money. And that's what they're willing to pay today. So the valuations of a lot of these AI companies today are high. That's what valuation means. In a very simple, intuitive term, it's how many years to get your money back at the current level of earnings. In technical jargon, this is called price earnings ratio. So a lot of the price earnings ratio, the valuations of these companies are very, very high. But does it mean that you should be concerned and there's a bubble? I mean, you use the word bubble. And the answer is, well, if you think bubble means that some companies are going to blow through money, create nothing, go out of business, yes, I absolutely think that's going to be the case. In fact, if you go back to the other main main period when we had a similar situation, which is the internet, it's quite fascinating because we had that in the 90s and everybody heard about the bubble, the dot-com bubble, and all this stuff. But here's the reality, Jonathan, there was no entity called the internet. There was no monolithic investment called the internet, but rather what you had are a bunch of companies. And these companies are like horses in a race. And as the race gets going, the trouble is that it's not obvious who will be the winner. If I took you back on a time machine in the mid 90s and I said, okay, there are three websites, one website that sells toys for kids, one that sells books for reading, and one that sells pet supplies. And I asked you, well, which one of these will obviously be the future of internet retail? How many have said, oh, it's obviously going to be the bookseller? No, it's not. It wasn't obvious at all. All of these had the same kind of chance to get there. And Amazon executed better. But the thing is that you have to accept that in order to own Amazon, you also have to own eToys and Pets.com, just because it's not obvious which one will be the winner. And if you hyper focus on the fact, oh, that eToys and Pets.com went away, you miss the fact that Amazon became Amazon. You miss the fact that the same period generated companies like Google, which is pretty much a money printing machine, and all these companies that not only changed their fields, but became some of the largest, most successful in human history. So again, if you just make fun of the fact that Pets.com went out of business, you're missing the forest from the trees. Yes, those went out of business, but the companies that emerged more than made up for everybody else. And that's kind of the moment that we're in right now, where AI is not a monolithic investment. Rather, you have a bunch of horses in a race, and it's not obvious at all which ones will be the winners. But what I can tell you, folks, is that some companies are going to blow through a lot of money, they create nothing, go out of business. In fact, a lot of the venture funds who funded Facebook and Amazon and Google and so forth, the ones in Silicon Valley, if you listen to them talking, they'll tell you the same story. Listen, when we invest in 10 companies, we expect that maybe six of them are going to create nothing, blow through our money, go out of business. We know that's going to be the case. Two or three of them maybe are going to chug along, maybe get acquired, nothing to brag about. And one or two are the moonshots they're going to more than make up for everybody else. And I think that private equity logic is now permeating in the public markets, even though this has been the case for the markets for the longest time. If you look at the markets, the US stock market over the long run, and you start at 20-year cycle and you say, okay, at the beginning of a 20-year cycle, on average, there are about 3,000 companies in the US stock market at the beginning of each period. And you ask the question, well, if you look at after 20 years, what fraction of these companies are still going to be part of the market? What's amazing is roughly 60% of them disappear. Only 41% of stocks survive. And out of the ones that survive, only about 18% actually outperform the market. In other words, the great results of the market and the great results of these private equity funds, they're not driven by a large number, but a very limited subset of companies. And obviously, everybody wants to know which ones are the 18%. The trouble is that nobody knows. And if you decide to start picking among them, you're going to end up probably much more likely picking, four out of the five companies that go out of business or they underperform rather than the winners. And because the odds are really not for you, and that's why a lot of these venture funds and successful investors in the market do, is that you have to buy across the entire market and accept that a lot of these companies might not make it. And that's nothing problem. That's not a bug. That's a feature. And that's exactly what I expect to happen. But again, the companies that will emerge successful, the expectation is that the more they're going to make up for the ones who don't.
Apollo, I think that's a great note to end on, my friend. Let's stay diversified, and it's a feature. It's not a bug. I
Yeah.
like that. I like that. Thank you so much for joining us today on this webcast, Apollo, and our guests that logged on. We had some great attendance this afternoon. If you thought of a question and weren't able to ask it, feel free to shoot us an email. We'll be happy to help get that answered. You can email wcm@warburtoncapital.com. Don't forget to check out our new podcast, Wealth, Purpose, Peace, on YouTube, Apple, or Spotify. And other than that, we'll look forward to seeing you again soon. Thank you.
Great talking to you. Bye bye.